Hey everybody, Tim Harrison, Straight Up Mortgage Talk. Today we're going to talk to Michael Ventimiglia, and he's an estate attorney. He's going to tell us why we should have an estate and how it could save us anywhere from thousands to millions of dollars. Really important subject here, so let's get started. Hey Michael, appreciate you having you on here. I'm going to slaughter your name, Michael Ventimiglia.
Sounds good.
Or Michael V for the rest of this time, just so you know, people. So super excited to have you on here to help me with some questions and just estate planning and such. And I knew you were the guy when we were at Provisors and sort of going over estate stuff, and the people ask questions, and you just always know how to explain things in a sort of clear and concise way. I go, I got to get Michael on here because I have so many clients and realtors with questions about the stuff, and it's confusing. So what is estate planning and sort of the biggest, clearest, I don't know, is there like, I know there's a lot.
There is a lot. The term estate planning encompasses pretty much anything that has to do with your plans for how your assets will be controlled or disposed of when you can't do that. So the term estate planning covers anything from drafting a joint tenancy deed, in which you are essentially giving that property away to the joint tenant at your death, to the big ones, wills and trusts.
Okay. So I'm going to ask this question now, even though I have it later in the deal, and that I was thinking about. It's like, what's the difference between a will and a trust? Like, what's definition will, trust? Because a lot of times they're combined.
They work together.
Okay.
A will is a testamentary instrument. So all that means is it's a document that states how you want your assets to be disposed of at your death.
Okay.
It could be very formal, or it could be written on a napkin, as long as it's signed and dated and has testamentary intent. But all that will does is say where you want your assets to go.
Okay.
A trust is an actual sort of an entity that holds your assets both during your lifetime and after your lifetime. So the magic that a trust does is a trust avoids probate where a will does not.
Got it. So I just learned something new because I had no idea. I thought the trust was the document that held the that was that the will. That's funny because I never knew that. So that's kind of funny. I had it completely kind of backwards.
Well, the will is that sort of document that it shows up in every Agatha Christie novel and Columbo episode. It's what the will, the reading of the will. But when you're talking wills and trusts, as a lot of people do, the trust is really the main document. The will's kind of a little side player if you have a trust to really control everything.
Got it. So with a will and you don't have a trust, you get thrown into probate, and that's a bad thing. And tell us why that's a bad thing. Like, what happens, why it takes longer, just why people do trust instead of just doing a will.
Well, and I think we could combine this to something else we were going to talk about, which is what happens if you don't have anything.
Right.
And so really we could kind of go through the stages and
perfect.
a little better on each. So,
although, do you care if you're dead? Just kidding. Sorry.
Well, that's actually, you laugh. It's something we say all the time. All this sort of estate planning is you taking care of your future beneficiaries.
Right.
Because most of this happens when you're gone. And so if it costs $10,000, $20,000, what do you care? You're gone. That being said, as a estate planning attorney, talk about death a lot. My favorite scenario is hit by a bus. We all have a scenario, you just deal with it. Yep. So let's say tomorrow, you go out, you hit by a bus. You don't have a will, you don't have a trust, you've never thought about dying before. What happens is the state does not get your assets. A lot of people think, your stuff goes to the state. California doesn't want your couch. Instead, what happens is your assets are distributed via the California intestacy schedule, which is California has determined where your assets will go. And in general, that's your assets will go to your kids. If you don't have any kids, it goes to your parents. No parents, it goes to your sisters and brothers. It's a very complicated schedule to ensure your assets go somewhere.
Got it.
And if you have no will, no trust, the court, the probate court, oversees that distribution to make sure it was done right. That's what happens if you do nothing. Probate court, especially after COVID, has been very impacted. It typically takes 6 to 8 weeks to get a hearing to open a probate. And then the average probate procedure lasts anywhere from a year to 2 years, from opening to actually distributing the assets to the beneficiaries. Cost-wise, it's $500 just to file with the court to open a probate. Probably in total through the life of a probate, you're looking at court costs of $200 to $2,500, and then attorney's fees, which are done by a set schedule from the state, in which it's a percentage of the assets probated. It's 4% of the first 100,000, 3% of the next 100,000, 2% of the next 800,000, and 1% thereafter. So $1 million probate, which sounds like a lot, but with real property in California, you get there very quickly. You're looking at attorney fees of about $23,000, regardless of how complicated it is.
So when my clients say trusts are expensive,
Trusts
maybe
are
for you now,
10%
right? That's where you have to
of
care
cost.
about your beneficiaries, right?
Absolutely.
And who picks the attorney in those kinds of things like a probate? Do the heirs still get to pick, or does the court pick?
No. The heirs get to.
Okay.
If they can't afford or don't have one, the court will appoint one.
Got it.
Or people can do it what's called pro per, which is on their own, which that's no fun. No fun for anyone. So that's what happens if you have nothing. If you have a will, all it does is remove you from that intestacy scheme. So instead of your assets going to your kids and parents, brothers, what have you, your assets will go via your will. It could be all to a charity. It could be all to your best friend, neighbor, what have you. But the court still has to supervise. You still have to abide through the probate rules and the time it takes to do that. And the costs are the same. Attorney's fees are still the percentage of the assets that go through the probate. So you're looking at tens of thousands of dollars in attorney's fees.
Okay.
A trust, which is more expensive to set up simply because there's more paperwork involved and more time. But since a trust is like an entity that holds your assets, that you appoint a trustee, who is somebody who runs a trust, and during your lifetime, that'll be yourself, and you appoint somebody afterwards. Since that trust continues whether or not you're living, it does not need court supervision because it never dissolves. It doesn't create at your death. It's something you created during your lifetime. And like a corporation or other sort of entities we're used to, it just continues on. It has instructions that says at your death, I want my assets distributed, however. And
this person is that person I've designated to manage. In other words, to take over the CEO position of my trust is going to be this person because I'm dead and I can't do it.
Right.
The dog's going to do it now, which obviously can't. But you designate, whether it's an attorney or a family member, you designate that person who's basically taking over, right? But It's only after your death in most circumstances.
Most circumstances, death or incapacity,
there you go.
Everything's going to have an asterisk to it when you're talking to an attorney. But yes, after your death, the trustee completes your wishes, and there's no need for a court oversight. Trustee can ask for court oversight, can go to court if they have questions and so forth. But you avoid that sort of fee structure that's involved and time that's involved with the probate court. You can distribute assets for a trust within months.
Right. And that's the thing. So you just said it's more expensive. It's not more expensive. It's more expensive out of your pocket now, but it's not necessarily more expensive to the estate, right? Correct. So probably probate's the most expensive. And I mean, regardless, because let's say that your trust is, or your situation is really sophisticated and complex. Yeah, it's going to take more to set up your trust and will and all that. Mm-hmm. But it's also going to be much more hours and all that stuff if it goes to probate.
Well, absolutely. And if you have something complex, where you have kids with different age distributions or special needs, somebody who may be getting government assistance that you have to worry about,
Right.
really can only accomplish that through pre-planning and a trust. Wills, you could have some sort of limited trust, but it's not, it doesn't afford you the sort of ability to really plan that a trust does. Courts want to get you out of there. They don't necessarily want to do everything that you want to do.
So we kind of understand the difference now. We know kind of like, hey, if we just do nothing, it's going to end up weeding down what, our
Nothing court,
beneficiaries
court,
get, and it goes to whatever the court says it's going to do. If we have a will, at least we say what wants to happen, but it still has to go through probate and the same fees.
Mhm.
If we have a trust and will, what did my trust attorney call it? We control it from underneath 6 feet under. We know what's going to happen.
From beyond
we
the
know
grave.
that's the word. That's the word. And so, and it also saves money in the long run, right? If you're going to leave something, you might as well leave more, and obviously. So the question is when should people start thinking about a trust? Because first of all, we've got a lot of people who maybe don't have that many assets listening to this. They're just starting out, getting their first home. Like, when is it important to start thinking about estate planning? Obviously, some trusts are going to be getting a trust might be more expensive for some. They can't afford it. Kind of like, when should we do it? What's the cheapest way to do it? And my rumor is from attorneys, any trust is better than no trust or will and trust.
Yes, I think that's fair. Any sort of thought and pre-planning to your desires at your death is better than nothing.
Got it.
Usually a significant life event of either buying real property or having
Okay.
children. It's really at the bare minimum of when you need to do estate planning. Here in California, until you have it's $166,000 is the number. Till you have at least $166,000 in assets, you could avoid probate completely.
Okay.
So, your average college kid is fine.
Right.
That being said, when you have children, regardless of the amount of your assets, you should at least have a will so you can name guardians who could take care of your kids if something happens to you.
Got it.
And avoid fighting with grandparents, figure it out. And then
Right.
then really here in California, when you buy real property, you should have a trust.
Right, because
it should
if
be
it's
part and parcel.
because if it's like now, 4 months later, you have $166,000 in equity. Sorry, the time we're doing this is 2021, and it's been a crazy ride, right? In case somebody listens to this later, it's just been insane. You have equity quickly.
Yeah.
So,
well, and it's not just equity; it's value of the asset. So
right.
So you may be mortgaged up to the hilt. You still have to go through probate.
Correct. So it doesn't even not even equity. You're just saying I got a $350,000 house. I got to go through probate and spend all this money, or my beneficiaries.
Well, because there's nobody who could is in a position of power to sell that house and pay off the mortgage unless they're appointed by the court or a trustee of a trust.
That's awesome clarity. And you're just talking about asset, where I think equity.
Right. Yeah,
you're just saying, so it doesn't take much you're right. College kids are probably the only ones. It doesn't take much to get to 166. Once you have real estate, you're done. So pretty much everybody that I would have listening to this, like, you should get a trust and a will. Here it in the story.
Absolutely.
So what about some of the new laws, right? We've had Prop 19, we've had some of these other things that have probably made some of this a little bit more complex, but for the main people, not necessarily people with multiple properties and all that, but what are some of the main changes? Because I think, if I'm right, there's been some changes that affect trust and wills just more recently.
Well, it's a continuing stream of changes. Trusts are creatures of state law, so they're very heavily affected by stuff that happens here in California. Prop 19 is the most recent complication. And then we're also affected by federal tax laws. So the biggest change and the looming change on the horizon is what's going to happen to the estate tax exemption. Currently, it's $11.7 million per person. That will index up until 2026, where it drops it by half. to 5.7, 5.8, whatever it is at the time. That being
And
said,
explain that for the novice people who probably don't, 99.9% of my clients probably don't have this problem.
right.
But basically it says you can transfer these properties into your beneficiaries up to that level, and they're not going to pay taxes on that transfer. But okay, you explain it. But in other words, define this a little bit for people to know, what does that mean as they lower it?
Okay.
Still probably doesn't affect most of us,
right?
But it's a pretty big impact for those it does.
Absolutely. So very quick primer on estate tax, because that's really the genesis of this whole trust idea here in the States, was to avoid or minimize estate tax. So we have a national estate tax. If at your death, the value of your estate, that's all the assets you have ownership and control over, and those are very important sort of terms. And then any sort of assets that are part of your estate at your death, such as life insurance. If the value of all that exceeds the estate tax exemption, then you are taxed on that excess. So currently the estate tax exemption is 11.7 million. If I die and I have $10 million in assets, then my estate does not have to pay estate taxes. I am below the estate tax exemption.
So the important thing is Benny's get all the money.
You're right.
Don't have to give it to the gov.
Right. There's not, government doesn't get
We like that. People like that.
We're good with that.
We like that part. Yeah.
If my estate's $15 million, then the difference between that 15 million and the exemption at my time, 11.7, my estate would have to pay tax on that $3.3 million.
And what's the tax rate? Is it defined?
I believe it's 40%. It's ridiculously high.
It's so high that nobody wants to do that.
Nobody, and
it'll make us crawl out of our grave and complain about it.
It makes you shake your fist.
Just like a fist coming out of the ground. I mean, it's literally like thrillers, starting all over, right? Everybody's
Absolutely.
coming out of their graves and dancing. I'm aging myself with that one right there. Just so you know, I'm going to have to explain this to some people watching this, like what that means. The Michael Jackson Thriller, just go watch it. It's a greatest video ever. So, right. So we go in there, we have the trust, we have the will, and we avoid this, but I'm going to backtrack because I think I learned something earlier that applies to what you just said. And that is the value of the assets. And I always thought, okay, if I have $1 million property, if I have $500,000 loan, that means I only have $500,000 equity. But you're saying it's based on the actual value of the asset. So I could have $6 million or $12 million in real estate, be loaned up to the gajibers, right? And only have like 1 million in actual, or is that going to be, how's that work?
You're conflating probate with estate taxes.
Okay. So estate taxes, the asset is the equity, the actual true money, right? Okay.
Yeah, the accountants can do lots of magic on returns, and I will leave it in their capable hands and future podcast to go through all that specifics.
But it's not just based on the value of the asset. That is based on what would be transferring.
It's
to some degree.
It is very particular, and it was a year in law school for that. So I will do my best to digest it into a tiny sound point.
So now
the takeaway is it doesn't affect most people.
Right.
And if it does affect you, there are ways to make sure it doesn't affect you.
And that's why those people pay you the bucks to get it done right, because it saves 40 cents on million. I mean, that's 400,000 just on an extra million. Yeah. So it's pretty cheap in the whole scheme of things to be prepared as compared to not be prepared. And then just lots of reasons why to do that.
We've saved clients millions in estate.
Right. It's pretty easy at 40 cents on the dollar, right?
Very easy.
So let's say I want to get into the fun stuff now.
Okay.
Right. So somebody dies and the kids are going after each other for the money. How does like the estate planning keep that down to the minimum? My favorite statement is if you dispute it, you're out of it, right? So that's like the new thing that everybody does in their trust. But it's a tough time when somebody passes. That's usually when this estate planning stuff really becomes important. And to me, like, I don't care about the money when it really comes down to it. I want to avoid taxes. And yes, I work my butt off. I want it to go to the people I want it to go to, I've loved and take care of and all that. But I really don't want what can happen. And we've all seen it, where the ugliness. How can estate planning reduce that kind of strife among families who are grieving somebody and maybe don't know how to handle it? I'm going to give them the benefit of the doubt. They're not greedy, right? Which is probably really a little bit of it. But how can that help reduce the amount of tension in the family after you go?
Well, that's a great way of framing it. It's reducing it. You can't avoid it. The
Right.
only way you could avoid the tension is to not die with family.
Because they're going to miss me so much. They're going to be just, oh my God, so distraught. Right.
The way it really reduces it is a verifiable document of your loved one's wishes of where they want their assets to go. And by going to an attorney or another sort of qualified person to help draft that trust, you now have a independent third party who, we can only work on clients who have what's known as testamentary capacity, which has their wits about them. We are charged through our oath with the bar and so forth, making sure that these clients aren't under undue influence, that nobody's holding a gun to their head saying, Clara's getting all my tea towels and Bobby's getting nothing. It minimizes, because it is what your deceased loved one wanted. And it's somewhere you could always go back to it. On the harsher end of it, trust and most wills include what's called a disinheritance and no contest clause, which is essentially if you bring a lawsuit challenging the terms of this trust and you don't win, and you don't have verifiable hard evidence and you don't win, you're disinherited. So you're risking your inheritance to try to challenge and get more.
So that's kind of a dispute reducer, right? Just because people have to risk it all and really feel really strongly about it if they're going to do it. I was going to ask you, like, are those actually really, do they actually really work? And you're kind of giving the impression like, yeah, they actually work. That if somebody goes in there, somebody else could say, hey, you've disputed this. And so you're out.
I didn't win.
And you didn't win. Now, okay, so we got a lot of people who pass and all this kind of stuff. And then all of a sudden they have to have a value of the asset at the time. And so in my business, how soon should somebody passes, takes a while to work through the trust potentially, you have multiple properties, let's say, or even one real estate property. When should that appraisal, that time of death appraisal, be ordered? Like, how soon should they have that? Can they backtrack and do it? What's the best timing on that?
Well, honestly, the best time for doing that is when you're able and comfortable in doing so. Grieve your loved one, move on. It's part of the regular trust administration process. You will get a value of your assets, and all the values are backdated to the date of death. It's not a current asset value for that time. It's a date of death value.
So it could be your business, it could be your real estate, it could be everything.
Right. And you want that for multiple reasons. One, you want that valued for potential estate tax exposure.
Got it.
You want that. You also want that valued because either most beneficiaries in most situations get a step up in basis based on that valuation for future tax purposes. So if I inherit a house, I want to know what the value was on the date of death, because that's my new tax basis if I were to sell that asset in the future.
So let me explain that to people, because that's something I was in the mortgage business for like 15 years before I actually understood this. So if I buy an investment property and I buy it for 100,000, it's worth 500,000. And let's simplify it and say, let's say that's my tax basis. You can listen to my other podcast to understand 1031s and Prop 19 that we talk about, to understand some of the background on this might help. But let's say it's 400,000. If I go sell it right now and it's an investment property, I don't live in it, I'm going to pay capital gains on that $400,000 gain. Minus cost to get it, minus cost to sell it.
Everything has
fixing
an
up. Right. Those things. Right. After that, I'm going to pay right now what's 20% federal and probably 9% state. I'm going to lose 29% of that 400,000. But if my son or whoever it's, left to inherits it, there's a step up into the tax basis to what the value is at the time. So let's say it's still 500,000. Now that 400,000 isn't subject to capital gains up to a certain level and all that kind of stuff, right? That's part of what they might try to attack down the road here, but it's basically takes that into that estate tax port, right? The 11.7, is that how it works? So for example, that $400,000 would be included in what where the estate tax hits, what could be left of them at some point in time. If somebody's really, really wealthy, you're not going to, the step up in the tax base isn't going to matter because you're sort of over the 11.7 or whatnot, right?
Somewhat, yeah. And the thing to remember is that beneficiaries get this step up in basis. So if they want to turn around and the moment they get it, sell the property, it's tax free. They don't pay taxes because there is no increase in value as to when they held the property.
Got it.
And that increase in value is sort of given as a gift, a tax-free gift.
So this leads to why, my next, Smart Up, Straight Up Mortgage Talk was my first book on sort of acquiring real estate, what mortgage insurance is, sort of basics, right? The next one's it takes a generation, because the only way to really build wealth is to die and have everybody else go ahead and be able to get that step up in the tax basis, which is huge.
It's huge. And that's probably why, just to touch on, and please listen to his other podcast, Prop 19 has been so detrimental to a lot of estate planning and people's issues.
Well, really good for the real estate.
It doesn't change the tax basis for income tax purposes, but here in California, property taxes are just as important and obliterates Prop 13. So
right. So unless you live in the house that your parents left you, you're going to have right now, you get to keep their property taxes on all properties, which is what Prop 19 says. Unless you move into it, you don't get to keep it. Every property there will go up to whatever their taxes are based on this, let's say 1.25% of the value right now, which makes a lot of rentals not work so not. So this is what I call the realtor employment job, right? Because people are going to be like, well, my taxes are going to go up so much. My rents aren't that great anymore. The revenue, I'm going to sell the property because of the step up in the tax basis and get real money tax free. Mm-hmm. So it's right. It's like realtor employment. It's a realtor security. Absolutely. I'm telling you. I mean, there's going to be a lot more properties that come on the market. What to some degree is a good thing, right? More properties. We've got problems with inventory.
Right.
We'll see how it works. Not good for the people that own properties.
Not good. And it's not good for people with those, I always think Balboa Island vacation homes that have been in the family since 1920. They're going to get old.
Yeah. Well, so here's my last question. Okay. What questions should have I asked that I didn't ask, or important things we didn't touch before we sort of wrap? Obviously, there's a lot to do with estate taxes and estates and all that kind of stuff. I mean, it's really something to sit down with a professional like Michael to really go over. It's not a simple deal. And yes, you have to address your death and your, eventual demise. But if you don't, it sort of leaves a lot of things hanging. Where do things go? Who gets your kids? Paying extra taxes. It's very important stuff. Any questions just things you think we should touch on that is like a major, we missed this and that, and people are going to listen to it and say, can't believe Tim and Michael missed that.
Well, two things. I'm gonna do two things. One is we've talked a lot about death, but what happens when I'm still alive but can't manage things?
Right.
That's a big part of creating an estate plan, a will and trust for you, is the durable power of attorney, advanced healthcare directive, authorization for release of healthcare information. These are documents that cover you while you're alive, but you're incapacitated. And I think those are really important to keep in mind, especially for how we talked about college kids probably don't have enough assets. But if your son or daughter is moving across country to start their college adventure, once they're 18, they may be your little baby, but in eyes of the bank, they're an adult. And just because you go to Bank of America and say, I'm his mom, I'm going to write this check, they're not going to handle it for you. You need a durable power of attorney. So it's worthwhile setting that stuff up for anyone who's an adult. And then the second kind of question is, why need an attorney anyway? I could spend $70 on Quicken's will in a box and make my own will. Why do I need to spend $2,000-$3,000 setting up a will or trust? And that's very simple. Is we are not round pegs to fit in round holes. We have curves and spikes, and everyone has a situation. No one is generic. And there's no reason to try to shove yourself into somebody else's pre-planned idea of what a will or trust should be. It's worthwhile sitting with somebody who does this on a daily basis, who's seen consequences on both sides of trust and trust administration, and really craft something that works with your situation, your plans, your family, and hopefully your desires at the end.
Awesome. That I'm so glad you and the health directive, just kind of tell people like, I'm a vegetable, I don't want to live anymore. I don't have brain. And
Right.
that tells people, yeah, you can pull the plug. I don't want to live like this. I don't want all my millions to be spent on keeping me alive when I have no brain. I want it to go to my beneficiaries. And that's something you can put, that medical directive. A lot of, people listening to this might be really young and not understand what that is, but is that kind of in a nutshell that I capture that?
Pretty much, yeah. It's what a lot of people call a living will. It's Advanced Healthcare Directive. A lot of times Kaiser and other insurance companies do it for you. And it states your desires as to intravenous feeding and organ donation and pulling the plug, how much extraordinary effort should be made. Should your dollars be spent for home care? Are you fine in a convalescent facility? Lots of sort of these pre-planned decisions that
families don't like to talk about.
Right.
And yet you have an opinion on it. You said you don't really, as soon as you start talking about that with your kids, they're like, I don't want to hear about it.
Right.
That's not going to happen to you. Well, unfortunately, at some point in time, it could very well happen to you. And maybe you want that spelled out so that they're not fighting siblings or whatever
Right.
over what is mom or dad's or whoever's desires. Like, well, I don't know. Well, I think, hey, here it is. Again,
make the decision
family
on
disputes
your own.
kept down to a minimum.
Yes.
All right, Michael. So that leads into, I love the addressing the fact, like, a will in the box, right? People, not only my business, every business that I see, spend a hell of a lot of money and leave a lot of money on the table by trying to save a few bucks up front. And I just want to tell people, look, I've done this. I've updated my trust. I've had this kind of conversation. It is absolutely important that somebody walks you through this. Yes, any will and trust is better than none, but really having this nailed can save you, again, like not having a trust or will is going to cost you thousands of dollars in probate. Doing it wrong is also going to, it's worth the investment to go from 70 to a couple grand to $3,000 to get it done right, because it's like not going to CPA and try to do your own taxes. Inevitably, you're not going to save as much. You're going to end up spending more. You could have done a lot better and safer, not put yourself at risk. And so that leads me to, how do people get a hold of you? Where it's your sort of specialty? Is there a certain range that for your kind of clients? How do the people with not as much money, or does it matter? How do we get somebody? Because it's extremely important to me for people to have access and avenue to really start getting wills and trust done. Even asking the question, like, is it time for me yet?
Right.
How do we do that?
Well, you certainly contact us or one of the many estate planning attorneys here in the Claremont area. We here at Taylor, Simonson and Winter are celebrating our 35th year this year of serving Claremont and the surrounding communities. We're here in the village. You could always give us a call.
That's a Claremont Village for you people that live outside of Claremont. I don't know who you are, but there you are.
Who would want to live outside of Claremont? The devil's in the details as always, but full estate plans, sort of trust, wills, durable power attorneys, healthcare directives, grant deeds, all the fun stuff, usually runs between $3,000, $4,500 for the full soup to nuts.
Right.
And that's not based on the size of your assets. It's based on the complexity of the trust. People with one house and two kids but they want everything to go to tiny little portions. And you know what? They're going to pay more because it just takes longer to draft.
Right.
That being said, just coming in for a consultation at our regular sort of hourly rate, we have lots of clients who we counsel and really just do wills only because their estate can be satisfied with a will. Most of their assets may have beneficiary designations and IRAs and so forth. So we're just sort of able to craft what's appropriate and not overly complicated for the situation. Especially in the 80s and 90s, and when you go to the Century City firms and the large firms, they're making money on making things as complicated as possible.
Got it.
And certainly the firm's sort of feeling on that is if you're not understanding it, it's not worth having. And there's no reason to be any more complicated than you need. And there's no reason for you to sign a document that you don't understand. Right. So we really try to craft and make everything as simple and as complete as needs to be.
And where's the best way? Like phone number, email, how should they get a hold of you?
Well, we have our website, which kind of describes each of the partners in our firm.
Okay.
That's www.tsw-lawyers.com. I have no idea who made that website. It's as complicated as possible. Our phone number is a lot easier. 909.
Yeah, I like that. Talk to somebody. 909.
Yeah, 909-625-4785. And you could ask for me.
Could you repeat it again?
Huh?
Repeat it again. 909.
One more time. No interruptions. 909-625-4785.
And you're going to ask for Michael V, so you don't have to pronounce his last name. They'll know who he is.
It's a gatekeeper. You have to pronounce his last name.
Ventimiglia. Don't pronounce the G that you see on the screen and you're going to be fine. I just learned that today. Michael, thank you so much. I really appreciate the time. And this is going to be super helpful to a lot and hopefully save people thousands and thousands of dollars over time.
As long as it starts a conversation, that's worth having.
Exactly. Thank you so much.
Thanks, Tim.